The dream of owning a home has long been a cornerstone of modern society. It symbolizes stability, success, and a place to call oneself. But what happens when this dream becomes increasingly out of reach? In cities worldwide, home prices are soaring, and fewer people can afford to buy them. Every year, more Americans find homeownership slipping out of reach. The U.S. faces a severe housing affordability crisis, prompting fears of an impending market crash. Entire generations are left treading water, unable to secure their future, while the wealthy and corporate landlords see their investments soar as demand continues to outstrip supply. This situation raises critical questions. If most people are priced out, what's fueling the skyrocketing housing costs? If no one can afford to buy, who will purchase these homes? Perhaps this is why UK house prices have started to fall, seeing a 4.7% drop in the past year, the largest since 2009. In the US, prices are beginning to stagnate after years of relentless increases. Yet homeownership remains a distant dream for many. With stagnant wages and dwindling homeownership, what lies ahead for the housing market? Are we witnessing the onset of a crash, or will the market reset and repeat the cycle? For years, buying a home was seen as a milestone of success, a key to thriving. Today, it's more of a fairy tale, a relic of a time when homes were affordable on a single salary. Overpopulation, inflation, inequality, and limited supply have created a perfect storm, making today's housing market the least affordable in decades. Despite falling prices in the UK, average homes still cost over £260,000, £45,000 higher than in 2020. This spike can be attributed to the Bank of England's 14 interest rate hikes in 2 years, making mortgages more expensive and dampening buyer enthusiasm. Even as prices drop, the dream of homeownership remains elusive for many. Real estate magnates like Warren Buffett sense a storm approaching. In 2023, his firm sold over $20 billion in stock. Amidst crashing stocks and real estate, diversification becomes key. Many are turning to unique, reliable assets like fine art to protect and grow their savings, leveraging platforms like Masterworks, which has generated significant returns for investors. In the short term, the UK faces a potential housing market crash. The post-pandemic recovery hasn't gone as planned, with inflation outpacing wages. With interest rates previously at 0%, many people took advantage of cheap mortgages. But the landscape has since changed drastically. In June 2021, over 165,000 homes were sold in the UK. By April 2023, that number had plummeted to just under 40,000. The dramatic decline in home sales indicates a cooling market, but it also underscores the challenges buyers face in securing affordable mortgages. The market needs to stabilize to provide more opportunities for homeownership. The U.S. has seen a similar trend. Over 6 million homes were sold in 2021, but this figure dropped by 1 million in 2022 and is expected to fall to just over 4 million this year. The average mortgage payment has increased significantly, and as fixed-rate deals expire, homeowners will face higher monthly payments, echoing the financial strain of 2008. Many homeowners are struggling to keep up with rising mortgage payments, which is putting additional strain on their finances. This situation is eerily reminiscent of the lead-up to the 2008 financial crisis. Many Americans are already burdened with debt, and falling house prices could exacerbate their financial woes. Without equity, downsizing becomes nearly impossible. Despite the necessity for lower prices to enable homeownership, such a drop could ruin millions of financial plans, highlighting the toxic view of homes as investments rather than necessities. The roots of this crisis lie in the post-World War II era, when homeownership was encouraged through policies like the GI Bill in the US and extensive housing construction in the UK. Over time, as demand outpaced supply, housing became an investment commodity, driving prices up. By the 1970s, the baby boomers had entered the market en masse, and banks saw a profit opportunity in mortgages, leading to the development of mortgage-backed securities. However, as time passed, housing became a profitable investment rather than a necessity, leading to restrictive zoning laws and a slowdown in new construction. This shift was fueled by innovations like mortgage-backed securities, which turned mortgages into profitable investments for banks, but also laid the groundwork for the 2008 crash. Louis Ranieri revolutionized banking by creating mortgage-backed securities and bundling mortgages into profitable assets for banks. This innovation transformed mortgages into a major financial product, setting the stage for the 2008 crash. Despite the catastrophic fallout, the financial sector's approach to housing has remained largely unchanged. Mortgage-backed securities turned housing into a high-stakes financial game, contributing to the volatility we see today. The lessons from 2008 have not been fully integrated into current practices. Today, institutional investors like Blackstone and Goldman Sachs dominate the housing market, buying up single-family homes and turning them into rentals. This corporate takeover has led to higher demand and prices, making home ownership even less attainable for average people. When corporations buy homes and turn them into rentals, it reduces the availability of homes for purchase, driving up prices and making it harder for individuals to buy their own homes. Today, large investment firms and corporate landlords dominate the market, exacerbating the crisis. These entities often prioritize profit over tenant well-being, contributing to high rents and reduced affordability. The entry of Silicon Valley into the housing market, with companies like Opendoor, has also failed to provide sustainable solutions, instead adding to the volatility. Renting, often seen as an alternative to ownership, has become increasingly unaffordable. High rents trap many in a cycle of financial strain, making it nearly impossible to save for a down payment on a home. This dynamic drains the economy and highlights the broader economic impact of the housing crisis. However, a few key factors seem to be artificially propping up housing prices, creating a market that feels increasingly out of reach for everyday homebuyers. Number 1. Real estate investors and corporations. Real estate investors and corporations play a significant role in driving up housing prices. By purchasing properties in large volumes for rental income or short-term rentals, these deep-pocketed investors can outbid regular home buyers. This reduces the available inventory and further drives up prices. When investors buy properties in bulk, they often do so to generate rental income. This competitive edge over individual buyers, who may only be looking for a single home, significantly drives up demand and prices. Number 2. Foreign buyers. Foreign buyers also contribute to the rising prices. International investors seek assets in stable real estate markets, often purchasing homes in desirable cities to park their money. This additional demand exerts upward pressure on prices. Cities like New York, London, and Vancouver have seen significant investment from overseas buyers. These investors view real estate as a safe asset, further driving up prices and making it even harder for local buyers to compete. Number 3. Speculators. Speculators, individuals who buy properties intending to resell them at a higher price, also contribute to inflated values. Cash-buying speculators have a massive advantage over people who must finance at newly increased rates. Speculators often buy properties, holding them for a short period, and then sell them for a profit. This practice inflates property values beyond what local incomes can support, making housing less affordable for the average person. Number 4. Low interest rates. Low interest rates have enabled more leverage by investors and consumers, allowing them to bid prices higher. This was particularly problematic during the years of low interest rates, which made borrowing cheaper and increased demand. When interest rates are low, people can borrow more money, which means they can afford to bid higher on properties. This drives up prices. But now, with rising interest rates, only buyers with excellent credit can secure the best rates. Number 5. The resulting bubble. If everyday homebuyers can't afford to buy, but prices keep rising, it suggests a bubble inflated by investors and speculators. Significant corrections are needed for housing markets to align with wages again. To correct this imbalance, those currently benefiting from high prices must pull back on purchasing. Allowing values to reset to sustainable levels is crucial for the long-term health of the housing market. Understanding these factors is the first step toward a more balanced and accessible housing market. With informed policies and responsible investing, we can hope to see housing prices stabilize, making homeownership a reality for more people. If regular people can't afford to buy homes, but prices keep going up, it means investors and speculators are inflating a housing bubble. To fix this, prices need to drop to match wages. Those who benefit from high prices need to slow down their buying so values can reset to a more realistic level. Real estate investors and companies are buying many properties, driving up prices and pushing more people into the expensive rental market. This makes it even harder for younger generations to build wealth through owning a home. To avoid this, we need to build more houses with fewer restrictions and keep mortgage rates stable. High home prices create economic inequality and make it tough for young people to get the financial security their parents had. Improving financial education and making policy changes can help. By teaching people how to manage money better and creating policies that stabilize the market, we can make homes more affordable. If we let the housing market operate naturally, without favoring big investors, prices could become more reasonable. Affordable housing can still be possible if we focus on the needs of regular buyers. In fact, owning a home with a 30-year mortgage is often cheaper than renting in most cities. Homeownership could lead to greater financial well-being, both now and in the future. Yet, according to a Redfin report, only 21% of homes sold in 2022 were deemed affordable, down from 60% in 2021. This indicates a rapid decline in housing affordability. Contrary to what some might believe, housing prices continue to rise because they do not need to be affordable for people to buy them. The focus has shifted from saving for a full purchase to merely saving for a down payment. While wages have not kept pace with rising housing costs, the lower growth rate of down payments makes it possible for some people to enter the housing market. For instance, the average home price in the U.S. increased from $230,000 in 2020 to $330,000 in early 2023. With the average American salary around $59,000, saving for a 20% down payment has become a daunting task. Investors also play a significant role in sustaining high housing prices. Many investors, including large institutional buyers and real estate investment trusts, REITs, are still purchasing properties, often without the need for traditional financing. They are driven by the potential for rental income or resale profits, rather than personal housing needs. This investor activity has contributed significantly to the surge in housing prices. While there is some indication that this trend may slow, such as a decline in investor purchases and market adjustments by REITs, the housing market's resilience has been surprising. Even though the dynamics may change, the barriers to home ownership remain formidable for many people. Wealthy families and institutional investors continue to acquire and hold multiple properties, potentially leading to long-term changes in property ownership patterns. In response to the housing crisis, people are increasingly turning to alternative models, such as communal living, co-housing, and multi-generational households. While these solutions are not comprehensive, they showcase the ingenuity and adaptability of individuals facing housing challenges. These innovative approaches should inspire further exploration of new ideas to provide affordable and dignified housing. As the affordability of homeownership continues to decline, societal attitudes towards renting may shift. Renting, often seen as a temporary or less desirable option, can offer stability, community, and flexibility. Policies that support renters, such as stronger tenant protections and rent stabilization, could make renting a more viable long-term solution. Addressing the root causes of unaffordable housing requires concerted government action. Potential policy measures include increasing funding for affordable housing projects, allowing greater density in urban areas, reforming zoning laws, providing rent subsidies, and regulating real estate investors who may drive up prices. A combination of these targeted policies could help create a more stable and affordable housing market. A significant barrier to home ownership is a lack of financial literacy among potential buyers. Education around credit management, budgeting, understanding mortgage products, and saving for down payments is crucial. Integrating financial literacy into educational curricula can empower more individuals to navigate the home buying process confidently and effectively. Despite the current housing crisis, there is hope that the next generation will develop innovative solutions to create affordable and sustainable housing. Learning from global examples, embracing technology, and allowing market dynamics to respond to supply and demand can lead to more equitable housing markets. By pursuing higher paying careers and entrepreneurial ventures, young people can increase their chances of achieving homeownership. The aspiration for a safe and affordable home remains a worthy goal.